Okay, so in this session, I just want to spend a little time introducing the concept of valuing securities and show you bonds. You should have seen this in business finance, so you should have some exposure to how to value a bond, but we'll start from scratch. I'll assume you've never seen it before. So we're going to value stocks and bonds. We'll start with bonds. They're more straightforward. The value of an asset is the present value of its future cash flows. So you got to forecast the future cash flows and then come up with the correct discount rate. The discount rate is going to be a risk-free rate plus a risk premium. We just saw that with the capital asset pricing formula, that the risk premium is beta times the market risk premium. For bonds, we'll add what's called a spread on top of the risk-free rate. But that's how you value assets. What if the only cash flow an asset has is a future sales price? Let's take gold. Gold doesn't produce any cash. The only way to get future cash out of gold is to sell it. Well, if your only cash flow is a future sales price, there is no income, there's no dividends, there's no coupons. In that case, that's called a speculative asset. You're just hoping that someone will pay you more for the asset in the future than you had to pay someone else for the asset today. So let's start with bonds. There's a few terms that hopefully you remember. So if you remember our 5-step process, first you forecast the cash flows. Second, you get the discount rate. Third, you discount those cash flows compared to the intrinsic value to the market price and make a decision. We're going to combine 3 and 4. We're not actually going to calculate the intrinsic value of a bond and compare it to its market price. We're going to try to come up with the market price of the bond. And then if you think the intrinsic value is different, that's because your discount rate is different, more than likely. So on bonds, because they're contractual obligations, the cash flows are very easy to forecast. So let's look at forecasting the cash flows. There's a couple of terms you have to know. One is the coupon. The coupon is stated in the bond. And we're going to assume, because this is the most common, that the bond pays that coupon every 6 months. So the coupon tells you exactly what the cash flow is. The principal amount, the face value, the par value, the maturity value, those are all the same thing. And that's how much you're going to be paid when the bond matures. We're going to assume it's $1,000, just to use a nice round number. Bonds are usually priced as if the face was $100. You'll see a bond trading at 96 or 102. But we're going to use $1,000. The discount rate I'm going to give to you. So you see this chart. This chart, what it does is it tells you the probability of default for different rated securities and for different time periods. So this very top one, let's look at the very, very top one. A AAA bond, in 1 year, none have gone default. In 2 years, very, very few have gone default. You see over time, over about 10 years, about 0.78% have gone default. This is through 2011, so it does include the 2008 crisis, but doesn't include what's going on this year, obviously. More updated numbers would probably be very, very similar. So it's hard for me to get updated numbers on these because these summaries are just they're produced just randomly by somebody every once in a while. So if you think about that, that's 0.78%. That's less than 1%. So if this bond were to pay you 10 basis points over treasuries, so if treasuries were 2%, 10-year treasuries were 2%, and this bond paid you 2.1%, over 10 years, 10 basis points times 10 years is 100 basis points, but on average you would lose about 78 basis points to defaults. And this default rate is just the defaults. But with AAA bonds, when a AAA bond defaults, you can usually get about half of your money, still get it back. So this ignores recoveries, it's on default rates. So if you take this 78 basis points and divide by 10, then on average you need 8 basis points a year and extra return over treasuries to cover you for investment risk, for default risk. AAA bonds is about 5%. I'd actually learn these numbers. High-graded bonds is about 1%. Single A is about 2%. Triple B is about 5%. So you take 5% and spread it over 10 years. That's about 50 basis points a year. So if triple B bonds paid you about 50 basis points over treasuries, you should come out ahead. And these have recovery rates too. They may not be as high as AAA's, but they may be 40% recovery rate. So you'll still, even if the bond defaults, get some of your money back. Triple B bonds historically have paid a whole lot more than 50 basis points, usually well more than 1%. So if you do 1%, that's like 10% over 10 years, whereas your defaults would only be 5%. So you should come out ahead. You can notice we get down to triple C bonds and double C bonds, over half of them default over a 10-year period. So very dangerous. And you look at the very bottom, investment grade versus speculative grade. Speculative grade is the double Bs, single Bs, and triple Cs. You can see the default rates. And you look at all securities, there's about a 10% default rate over 10 years. So if you got 1% a year, you should cover the average bond for defaults. If you assume your recovery is about 40%, then you should do really, really well. I remember my first job as security analyst, I bought some treasuries. It was only $5,000. I just wanted to see how the process worked. And the portfolio manager got really mad at me and said, "We don't buy treasuries. Why are you buying treasuries?" And I was just buying it in my own personal account purely to see how Treasury Direct worked. Not because I thought treasuries were a good investment, but he was really upset. And that's part of the philosophy where I worked is corporates pay so much better than treasuries. They more than compensate you for the risk. So why in the world would you ever buy a treasury? So I will give you that spread, and you'll see how we do that on the exam. I'll give you some example exam problems. We already talked about these key terms, except for this third one, the current yield. Anytime you see the word yield, you're taking current income over the last 12 months and divide it by the current price. So the last 12 months of income divided by the current price. There's also yield maturity or yield YTM. That's essentially the internal rate of return for a bond. So I'm going to be using current yield a little bit sloppily in this part, but that it works fine. And so the current yield is what we're going to calculate. It's going to be the risk-free rate plus a spread, the current risk-free rate plus a spread. I'm going to give you that number, and then you're going to use that as your discount rate with one exception. I mean, with this one exception, it needs to be adjusted for the fact that the bond pays twice a year. So you're going to take this discount rate and you're going to convert it into what's called the effective yield. Really simple formula. You're just going to account for the fact that the cash flows come twice a year. So you're essentially going to compound those cash flows twice. So 1 plus the current yield that you just got here, divided by 2 squared minus 1 will give you something slightly higher than this. And I'll show you that when we do the example. If the coupon equals the yield at maturity, then the bond's going to price exactly $1,000. If the coupon's greater than yield maturity, so you have a bond that's paying 6% in a market where everything else is paying 2%, you'll have to pay a higher price to buy that bond because its coupon is really good. If the coupon is lower than the yield maturity, if you have a bond paying 2% where the current market is doing 4%, you'll get the bond at a discount. You'll have to pay less than $1,000 to get that. We already talked about these equations earlier. You'll use that for exam 1. So the best way to do this is just to price a bond. I do have a video that walks you through how to do what we're about to do here. Let me just do a real quick example, and then we'll do more examples in the following class. So let me just give you some information. Let's say that we'll start today. I'm just going to do a treasury bond. In the next class, we'll do a corporate. So let's say we have a 10-year treasury with a coupon. Well, let's just say 10-year treasury. Let's say the coupon is 10 years ago. I don't know what it would have been back then, but it's 10 years today. But today I know interest rates are very, very low. This could have been a 20-year treasury sold 10 years ago. We'll do some examples like that. Purchase, excuse me. It could be a 20-year treasury that we bought 10 years ago, and so it has 10 years left on its life. So who knows? I'll give you the details. We'll work some of the practice examples. But let's say the coupon is 5%. We already said we're going to assume the face of the bond is $1,000. We'll just always do that. I do tell you that on exam, but if you don't see it on exam, just assume that. So let's say the 10-year yield to maturity, let's say right now is 1.5%. So yeah, this is a bond that maybe a 20-year treasury that was issued 10 years ago, so now it's 10 years left. When it was issued, 10-year treasuries you're paying 5%, but now they're only paying 1.5%. So this is what we're going to call a premium bond. It's paying 5% in a market where the best you could do is get 1.5%. So obviously you love 5%. I'd love to make 5% when everybody else is making 1.5%. And the person selling you bond, he says, well, that's fine, but you're going to have to pay me a whole lot more than $1,000. So then what we have to do is figure out the effective yield. Well, the effective yield, if you remember the equation, it's 1 plus the yield to maturity divided by 2 raised to the second minus 1. It's always that a formula. You always divide by 2 raised to the second minus 1. That's always the formula for treasuries and corporates that pay twice a year. And you notice you get 1.51%. So it was the effective yield will always be higher than the yield to maturity. That's just the nature of this formula, because essentially what we're doing is we're compounding that coupon. We're compounding that coupon twice a year, so we want to actually take the effective yield and assume we reinvest at that yield, but every 6 months, not just once a year. So that's how we get that. So we're going to calculate the bond's value, and here's the columns you need to have. You need to have time, you need to have the cash flow, you need to have the discount factor. Hopefully you remember how to do that from your business finance class, but if not, I'll remind you. And then we have the discounted cash flow. So for time, this is a 10-year bond, but it's going to pay every 6 months. So in 6 months it will pay, and then we'll take that and add another 0.5. So in 1 year, so you just take you input 0.5, and in the next period you take that cell and add 0.5 to it. We want to go down, so we go down 10 years. So about 20 lines. There we go. So go down 10 years. Then our cash flow is very, very simple. We just take the face of the bond times the coupon divided by 2. Since it pays twice a year, this bond is going to pay us not $50 once a year, but $25 twice a year. Then you just want to repeat that one all the way down, $25 all the way down, except for the very, very last period. The very last period, you'll get your $1,000 back. So $25 plus the face. So in the very last period, you'll get $1,025. All right, so there's the formula for that. I'll move it over to the side in case you haven't seen it yet. The discount factor is going to be, hopefully you remember this from business finance, 1 divided by 2 parentheses, 1 plus your effective yield. Here you've got to put the dollar signs around the B5. Your F4 function key should do that. And then you raise it to the time, the 0.5, close parentheses, and I would go out 4 decimal places. Then you can copy that down. You can see the discounting process all the way down. Every future cash flow is worth a little bit less than the previous one. All right, I'll put that off to the side just in case you haven't catch it. And then your discounted cash flow is real simple. You just multiply the $25 times the discount factor. And so $25 in 6 months would be worth $24.81 today if discounted at 1.5%. So we can just copy that down. Put the formula over there. Y'all see what I'm doing on the formulas. Just in case you missed out on it, you can freeze the video and get that. And so what is the price of the bond? The price of the bond is going to be the sum of the cash flows. If you watch the YouTube instructional video, it will show you how to do this, doing it on paper, because that's what you have to do on the exam. So what we'll do next class, I'm going to show you a couple of things. First, I'm going to do this with corporates. I'm also going to show you a shorthand formula that you can do so you don't have to draw at the table. I do on the exam, make this really important, I do want this entire table on the exam. I will not give you a 10-year bond. I almost always give a 2-year bond. So you only have to go down, for 2 years. So I'll give you the shorthand formula. We'll do the table again. But I'm also going to show you a way to estimate this value before you even do the math, so that you can test the shorthand formula, and the table will give you the exact same answer. The estimate should get you within $1 or $2. Should get you really, really close. All right, so be ready for this. Next class, we'll start practicing this, and we'll do a few examples, and then you have the YouTube videos as well, help you practice. So you should be in good shape for the exam.